So what we're going to do here, it gets kind of involved, but we're going to show two different case studies here. Now remember, this is our current tax bracket. I know we talked about it maybe going up in the future and all that. We're not going to look at that now. We just want to imagine that somebody wants to take larger than normal distributions out. That could be just a regular distribution from an IRA or 401k, or we'll see, wants to do a large Roth conversion. So let's see the effects on this. We're going to call this person A and person B. So Aaron, why don't we go full screen? Let me read the specs on this. So we have a male-female married couple, age 66. Their standard deduction is $30,700. Remember, most people are not itemizing like they used to be. They're taking their standard deduction. This, again, is a married couple. He has $2,300 a month of Social Security coming in. She has $1,500 a month for a total of $45,600 in Social Security. And they have some interest income of $5,000 per year. And keep in mind, this couple lives in the state of Kentucky, so any distributions from their IRA up to around $31,000 is not subject to state income taxes. Okay, so let's take a look at person A here. This person currently, because of their income, is in a 12% tax bracket, okay? That is very low, especially if you, let's put the old graphic back up, Aaron. I mean, look at how high these taxes have been in the past. I mean, some of them as high as 90%. So this couple, remember, is in a 12% federal tax bracket as of today, pretty low. In this example, the Social Security, because they're only taking a $30,000 IRA distribution out currently, their Social Security is only taxed at 38%. That doesn't mean they're taking 38%. That means that 38% of that, around $45,000 now has to go onto the income tax return to calculate their tax, all right? Then we look at the taxable income that goes on the tax form. It's only going to create taxes, federal taxes, of about $2,200. That's all. And notice that part of that's in the 10% bracket, and only $3.60 creeps up. That's why we call it creeping up, creeps up into the 12% bracket. So as you look at this, that's not a bad deal. They got Social Security of over $40,000 that year. They took a $30,000 distribution from their IRA. And there's no state taxes because, remember, the distribution stayed under the $31,000 limit, and basically they only owed the government about $2,200 in federal taxes. Pretty darn good. Let's go over to person B. It's actually the same situation. But now person B says, you know what? I went to a workshop recently, and the fellow was talking about Roth conversions. I want to do a Roth conversion. Sounds like a good idea to me. Then when I convert it, all that money will be tax-free. It won't affect Social Security. So I want to do a Roth conversion, and they arbitrarily picked $90,000. Okay, well, let's see what happens and what the effects of taking $90,000 from a tax-infested 401k IRA and converting that to a Roth. So there's the $95,000 IRA distribution, but look what happens. Notice the Social Security, remember over here, $17,000 had to go on the tax return. Now it threw the Social Security up into a higher tax bracket. So now 85% of the $45,000 Social Security, $38,000 has to go on the tax return. This is not looking good. You'll see this. So you have state taxes now come into being. You said, why were state taxes, Tony? Why am I having to pay state taxes? Well, you take $31,000, subtract it from $95,000, and that balance is subject to about 5% in taxes. So they also have state taxes now of $2,800 they didn't have under the first scenario. But it gets worse. We have the 10% bracket, but look at this 12% bracket. Remember on the other scenario, only $3.60 of taxes had to be paid at the 12% bracket, but now they're going to owe over $8,000 at the 12% bracket. But look at this. Because so much money has crept into the 22% bracket, they're going to owe $4,000 in additional federal taxes. So let's summarize this. To do this Roth conversion without any thinking and understanding of the rippling effect of doing so, basically this person went from $2,200 in total taxes paid all the way down to almost, well, just over $20,000 in taxes. So you might look at this and you say, well, Tony, I don't understand what to do here. I mean, the question is, do I do a Roth or not do a Roth? Do I put into a Roth or do I do a Roth conversion? You're not helping me here. Well, folks, that's the whole point. We can help you, but you can't rush out and do this stuff without a knowledgeable retirement planning firm like Tony Walker Financial, who works with this stuff every day. This is all we do. In fact, a lot of people will charge for these services. All of our tax planning services, assuming you're a client of Tony Walker Financial, come to you at no additional out-of-pocket costs. We will do these calculations for you to make sure such situations like this are right for you.
Thanks for watching. We hope you enjoyed that video. If you'd like, check out these other clips. And be sure to hit that like button and that subscribe button for more videos.